Hi, this is Darshan Bhatt from Glovista Investments with a market outlook for the month of October. This past month, the equity markets pulled back on a monthly basis for the first time since January 2021, with the S&P 500 index declining by 4.76% and the Nasdaq 100 index declining by 5.73%. The equity markets pulled back on the back of important developments both on the macroeconomic and market fronts. On the macroeconomic side, the activity calendar continues to remain resilient, particularly out of the US, where several of the macroeconomic releases came out higher than consensus expectations, including the Markit PMI, US ISM Manufacturing, Empire State Manufacturing, University of Michigan sentiment data, as well as the personal spending data. Meanwhile, on the ongoing virus wave, which has led to widespread shutdowns in Asia compared to other regions, continues to show signs of abating. This past month of September included an unusually important September 22nd FOMC meeting at which guidance was provided on the tapering of the Federal Reserve's asset purchase program, as well as an update on Fed's dot plots, which are individual governors' assessment of future path of policy rates. The guidance on the tapering side was more hawkish, particularly as it relates to timing within which such tapering process would be completed. The outlook on the policy rate side was also somewhat more hawkish, with the central tendency moving towards one rate hike in the year 2022. On the markets front, the unusually important September 22nd FOMC meeting coincided with a seasonally weak month of September, as well as days during which several of the Asian bourses were closed for holidays. In addition, news out of China entailing the potential default by the country's largest property developer, Evergrande, led to unusually high demand for hedging flows. Such a powerful cocktail of market dynamics led to a spike in implied volatility around September 20th and September 28th. Overall, during the month, the combination of macro and market dynamics led to higher government bond yields, a modest weakening of the US dollar, as well as weaker global equity prices. Within equities, the value-oriented markets and sectors outperformed their growth peers. Over the medium term, we continue to like equities as an asset class, and within equities, we continue to prefer value-oriented sectors and industries, including US financials, energy, emerging market equities, and select US large-cap tech stocks. On the macroeconomic calendar front, we believe the focus over the next few weeks would be on the confirmation of the ongoing resiliency in the global activity calendar, starting with the non-farm payrolls this week. In addition, we believe the market's focus would be on the beginning of the Q3 earnings season, with particular emphasis on analyzing the impact of supply-side shutdown on both top-line and margin dynamics for various sectors. Thank you for listening, and we wish you a profitable month of October.